Okay, be honest. Have you ever placed a trade right at the opening bell, only to watch the market violently reverse on you? Seriously, it feels like Wall Street is personally hunting your stop loss, right? Well, you aren't crazy. You just walked onto a battlefield without a map. Welcome to The Explainer. Today, we're diving deep into the us versus them reality of modern trading. We're literally peeling back the curtain on this hidden battlefield, a place where raw, chaotic retail emotion clashes head-on with cold, calculating institutional math. All right, here's our roadmap for today. We're going to start by mapping the battlefield, then we'll step inside the pre-market cage, explore the brutal border wars, decode what we call historical magnets, and finally, we'll arm you with your exact rules of engagement. Let's get into it. Section 1. Mapping the battlefield. We're talking about the architecture of institutional trading. You see, the biggest mistake amateur traders make is thinking the market is just a random series of squiggly lines and chart patterns. It's really not. It's a highly structured, mathematically defined war zone divided by very specific psychological boundaries. Institutions absolutely do not trade on emotion. They execute based on rigid, structural algorithms. Okay, let's dive into this. Grasping this clash is exactly why understanding market structure is a matter of pure survival. Think about it. When you excitedly hit buy because a stock looks like it's breaking out to the moon, an institutional algorithm is very often sitting right on the other side of that exact trade. They are perfectly positioned to absorb your momentum at a predetermined mathematical wall. So, what does this all mean? Well, think of algorithmic market zones as rigid limits. These are mathematical boundaries defined by the settlement of overnight inventory, the pre-market squeeze, and the main session volume. These zones literally dictate institutional behavior. They tell the smart money whether a market actually has the fuel to trend aggressively into open air or if it's just going to remain trapped in a tight, choppy box. Moving on to Section 2, the pre-market cage. We're setting the day's boundaries before the bell even rings. Because look, before that opening bell sounds, the battlefield is already drawn. Between 7 a.m. and 9:30 a.m. Eastern Time, the pre-market cage is built. This crucial window captures the heavy European and early U.S. volume. It settles the overnight inventory and sets the exact structural parameters for the trading day. Listen, if you look at absolutely nothing else before you trade, look at the size of this cage. If the overnight session was quiet, you get a narrow pre-market squeeze. That means the market is super vulnerable to an explosive trend expansion right at the US Open. But on the flip side, if a massive macro event happened overnight, like a war headline or a huge earnings miss, that pre-market container is going to be massive. And when the cage is that wide, the main session simply won't have enough volume to break out of it. You are mathematically locked into what we call nested shop, where your momentum strategies will literally just bleed to death. Now, this pre-market squeeze is actually held in place by three distinct anchors. First up, the 8:30 a.m. data anchor. When huge macro data drops, that violent repricing gets locked right into the pre-market edges. Those become absolute brick walls that require billions of institutional dollars to break. Next is the 9:30 fly trap. Right at the opening bell, algorithms intentionally use emotional retail volume to drive the price straight into those pre-market edges, purely to sweep up early bird stop losses. Sneaky, right? Finally, we have the 50% midline. This is your ultimate baseline, the exact agreed-upon settlement of institutional fair value right before the open. All right, Section 3. Border wars, the clash at the edges. This brings us right to 9:30 a.m., where live, chaotic morning momentum goes head-to-head with those rigid, pre-established edges of the pre-market cage we just talked about. Let's be real, the first hour of the day is amateur hour, and the institutions, they're just waiting patiently at the borders to collect their toll. Let's break down the anatomy of this battlefield. You'll quickly notice that not all zones are created equal. Your 20% edges act kind of like trampolines. They're soft, algorithmic reload zones used specifically to keep a trend going. But the 40% edges? Wow, those are your brick walls. This is the primary structural resistance where morning momentum literally goes to die. And resting right there in dead center is the 50% midline. That's the ultimate chop city pivot and your absolute primary target if you're playing reversals. Now, what's really interesting about this concept is the concrete wall. A concrete wall isn't formed by some random moving average you slapped on your chart. No way. It is mathematically formed only when a pre-market 40% edge and a main session 40% edge overlap perfectly at the exact same price. This overlapping 40% wall means that overnight macro algorithms and morning retail traders are in 100% agreement on a price ceiling or floor. It's essentially the heaviest defense on the entire board. But as we know, institutions are incredibly tricky.
Because that 40% concrete wall is so glaringly obvious, retail traders tend to just pile their stop losses right on the other side of it, usually at the absolute range high or low. And that sets up the ultimate hidden trap, the trapdoor sweep. Algorithms will intentionally step right over that 40% line, pierce the absolute extreme to trigger all those retail stops, steal that liquidity to use as fuel, and then violently snap the price back inside the zone. It happens all the time.
Which brings us to Section 4, Historical Magnets, the pull of algorithmic memory. You see, while today's structural walls dictate today's border wars, there are these massive, almost invisible forces that can completely override the current battlefield. We call these historical magnets, and they represent the relentless pull of algorithmic memory from previous trading days. Let's move to and see how this builds an institutional fortress. It happens in 3 steps. Step 1. A massive trend wave of institutional capital is deployed days or even weeks ago. That leaves a really heavy footprint, what we call an origin zone. Step 2, time passes, the market kind of forgets, and low-volume retail price slowly just drifts back down toward that historical box. And then, step 3, the very moment price touches the top of that old box, the original algorithms wake right back up to defend their settlement. They slam the tape with massive limit orders, triggering an explosive, violent rejection.
So, knowing how ridiculously strong these historical fortresses are, I want you to consider this for a second. Why in the world would Wall Street algorithms ever intentionally break today's perfectly good, mathematically sound 40% structural walls during a border war? Seriously, why give up the high ground?
Well, the answer is something called the proximity rule. If a massive historical magnet, let's say yesterday's unswept 50% midline, sits just 10 to 20 points right behind today's 40% edge, Wall Street will intentionally hijack today's edge. Yep, they will purposely allow that 40% wall to break. Why? Just to trigger the retail breakout buyers and stop-loss sellers. They scoop up that trapped liquidity, use it as jet fuel to propel the market right into that much heavier historical fortress, and then boom, violently reverse the trend. Okay, Section 5, Rules of Engagement, Aggressive versus Conservative Execution. Now that the battlefield map is fully drawn, the traps are completely exposed, and we've identified the historical magnets, how do you actually survive out there? Well, it all comes down to your rules of engagement, and specifically, how you manage your risk execution. When it comes down to it, you generally have 2 choices. Play A is your aggressive wave sync. This is where you enter deep inside the chop zone based purely on an algorithmic momentum signal. You're basically front-running the structural test. Now, your entry price is vastly superior, but you're anticipating a move that hasn't actually structurally confirmed yet. Then you have play B, which is conservative structure. Here, you're sacrificing that great entry price. You wait patiently for a physical candle to break and close completely outside the 40% shield, and then you buy the pullback to the 20% line. So, worse price, for sure, but you get rigid structural confirmation. But here's the deal. Whichever play you choose, your risk sizing absolutely must be dynamic. It's dictated by the market's current volatility. You have to calculate your specific risk unit. First, you define the physical space between your 20% entry line and your 40% edge line. Then, check the exact point value of that space. Listen, if you are stuck in one of those massive pre-market cages caused by overnight macro news, that nested unit is going to be incredibly wide. You must mathematically shrink your position size so that your total dollar risk stays identical to a normal, quieter day. It's absolutely crucial. So the crucial point is understanding the live risk math of that 40% line. Guys, this isn't a suggestion. It's a mathematical mandate. If you enter a trade inside the action zones, your structural stop loss goes exactly behind the 40% edge line. If a candle physically closes cleanly through that 40% wall, the institutional defense has completely failed. The setup is mathematically dead and you exit immediately. No hoping, no praying, just out. And honestly, that right there brilliantly illustrates the difference between amateur gambling and true algorithmic execution. The map is always there, you just have to know how to read it. So I want to leave you with this provocative thought. Next time you see a massive pre-market gap right at 9:30 a.m., are you going to blindly trade the retail emotion? Or will you sit on your hands, check your 40% edges, and wait for the institutional concrete to dry? Keep your charts clean, respect the math, and I will see you in the next explainer.